G'day, fools. I'm Scott Phillips, the Motley Fool's Chief Investment Officer here in Australia, and I'm here to bring you another episode of our very popular, I say that every time, but it keeps getting more popular, Stocks in Focus series, where we grab one of our analysts and ask them to give you the down low on a particular company. And with this series, we try and focus, at least for now, on the widest held, the biggest, the best known companies, basically the ones we think you might be most interested in, and we give a bit of a foolish comb over. We try and check the business, see what it's doing, see what it's up to, the pros and cons, and then tell you whether we expect it to be a market-beating investment from right now. Now, as always, when I say right now, I literally mean right now. This will go to air on the 22nd of October. Things change, of course. So we're telling you right now what we think of the business based on what we know, its price, and the announcements that we've heard from the business. Speaking of which, when I say we, I mean myself and, more importantly, Ryan Newman. G'day, mate. How are you?
Good, thank you, Scott. How are you, mate?
Mate, I'm exceptionally well, and thank you for rejoining me. I'm looking forward to another joke or two about my age, as has become our regular shtick, but thank you for doing that. I'm sure it amuses our audience, even if it doesn't amuse me quite as much. No, I'm kidding. Mate, you're going to talk about, speaking of old, one of the oldest companies on the ASX. It's kind of one of those businesses, it's at the same time one of the most storied companies, but also probably the least well-known big company on the country, because we all know its name, but by virtue of the fact it's a conglomerate, an old school conglomerate, and largely an investment company, its form kind of keeps changing. So the business we think we know, and of course I'm talking about Wesfarmers here, the business we think we know isn't necessarily the business that it was 10 years ago, 40 years ago, 80 years ago, or the business even that it'll be in 5 or 10 years, which kind of makes it fun, but also makes it challenging to investigate. So let's start, mate. Can you tell me, tell our viewers, the Wesfarmers story? What exactly is the Wesfarmers that we know today?
Sure. So Wesfarmers, first of all, it trades on the ASX with the ticker code WES. And it's funny because Wesfarmers, I guess a lot of investors would probably line this up alongside Woolworths. You know, it's long been thought of as sort of Woolworths and Wesfarmers. That's actually really probably quite inappropriate now. And the reason I say that is because Wesfarmers was the majority owner of Coles. Coles, of course, it acquired back in 2004 or thereabouts. It's actually divested the vast bulk of that position. I think it owns about 4.9% of that position now. The remaining Coles, of course, is separately listed separately on the ASX again. So, yeah, it can't really be thought of, I guess, alongside Woolworths quite as cleanly anymore. But absolutely, you're right in saying it's a conglomerate. Its origins span back to 1914, where it started off as a Western Australian farmers cooperative. And it's now one of Australia's largest corporations. So it's got a market capitalization of about $62 billion. And of course, its conglomerate is spanning several industries as well. It's still got a very big focus on retail, but other industries or verticals as well in terms of chemicals, energy, fertilizers, industrial safety products as well. So it's really broadened its horizons there too. It's also one of Australia's largest employers. It expensed about $5.3 billion in wages and salaries in the 2021 financial year. And it's also one of Australia's favourite dividend plays. Now, we've mentioned the word conglomerate a few times in this call already. And I guess now's a pretty appropriate time to highlight what conglomerate actually means.
Thank you. I was going to ask you that. I'm glad you covered it. Thank you, mate.
Well, a conglomerate is really a corporation that's made up of several different and often unrelated businesses. Now, Wesfarmers, I mentioned earlier, is largely in retail, and a lot of the brands that it owns or the companies that it owns are very, very familiar with consumers. Wesfarmers, the umbrella, I guess, if you will, the umbrella that is Wesfarmers, less well known compared to some of those businesses, but Officeworks, Bunnings, Target, now catch.com.au, Flybuys that owns 50% off as well. So it's really got a vast, I guess, array of businesses that it owns under this umbrella where Wesfarmers serves as the parent company. So those brands, many people are regular shoppers at, whether it be Bunnings or Coles, which, as I said, Wesfarmers owns nearly 5% of. It really shows, I guess, the range of industries that this company plays in. So really interesting business.
Yeah, chemicals, insurance, mining. It's been either in the past or now I think probably covered most of the Australian economy. As you say, from a humble farmers cooperative 107 years ago, heck of a journey. Maybe, it's testament to the fact you hang around long enough and do the right thing, you can get quite big. And I guess if you've got a 107-year head start, you've got no excuse not to be meaningfully bigger. But it's also done a pretty good job of making that transition. If you start as a farmers co-op, I can't speak to the farmers of the 20s, 30s, and 40s last century, but there would have been, I assume, some possible issue with, hey, do we want to be big? Do we want to be something else? And I guess they had to confront that. They went through the 60s and 70s where conglomerates were all the rage. There was a time, I used to work for Heinz, the food company, and at one point they actually owned the Stanley wine business, if you can believe that, plus a whole lot of other stuff. I've forgotten most of the businesses they used to own. Everybody used to be a conglomerate once upon a time, and it was kind of seen as the way you did it. You built an empire, you built a conglomerate, you kind of acquired this stuff. It gave you internal diversification, all that good stuff. And then we kind of had the 80s, and again, I'm giving you the history because I've been around here a few years longer than you have. We went through the process of saying, well, hang on, conglomerates are now bad because we can value. We, being the market, said, well, we can view and we can value a retail business, and we can value a property business, we can value a chemicals business and a mining business, but put them all together. And I'm saying there's a bit of skepticism, mate, by the way. The market would say, well, we can't do that anymore. And so there became this thing called a conglomerate discount where the market said, well, we don't know what to do with all this. Let's just value it for less than it's actually worth, which is bananas. If you think about the salaries paid to our peers in funds management businesses and stockbroking firms around the country, if they pretend there has to be a discount because they can't really understand the businesses, then I'm going to humbly suggest they get a new job. Slight editorial. Let's get back to the Wesfarmers business. So we now are in a position where it probably, and Soul Patts is probably the other one. I own shares in Soul Patts, by the way. One of probably the last two remaining old school industrial conglomerates in the country. And as you say, you're right. Even when you compared Woolies and Wesfarmers, there was always the reality that Woolies is a grocer by definition. Yes, it owns Big W. Yes, it's got other bits and pieces, but it was always a grocer. In fact, it's even more these days, having spun off Endeavour Drinks. Wesfarmers was always, as you say, seen as a retail business, but it really wasn't. It was always more a probably closer to a listed investment company because it had a board and it had some management at that corporate level. But Wesfarmers has never promised to be anything in particular. It was never always going to be, maybe it was at the beginning, always going to be a farming business. But it was never going to be only ever the owner of Coles. We may yet see a day when even the likes of Bunnings and Officeworks are spun off, sold off, or done something else with, because it's not, it's not in the hardware business as a core operation. Its core business is being an industrial investment conglomerate, effectively. So I guess the challenge for us as investors, and I'll ask you to answer the question, is on one hand, we know what the business is and does. On the other hand, if it's going to look very different or maybe no different at all in 10 years' time, how do you look at Wesfarmers as a business? Before we get into the pros and cons, by the way, just how do you think about Wesfarmers from an investing perspective? How do you approach it as a conglomerate when you kind of don't know where it's going to be, what it's going to do? How do you think about valuation? How do you think about the strategy of the company? Just how do you approach a conglomerate differently to a pure play operating business?
Well, I think for starters, one of the things that you need to look at is the strength of Wesfarmers' position in this market. It's obviously very well known. It's also got a very strong balance sheet behind it. So it does have that firepower to go after these sort of opportunities, as it did with Coles back in 2004, as it did with Catch.com.au and Geeks2U as well more recently. So right. I think that capacity gives it that power, and the confidence that investors need that it can actually go out and do this. And as you said as well, its business is really in, rolling out businesses, so to speak, and building out its empire, if that's the word you want to use, its empire. And given that is its focus, I think that's a really good way that investors can look at this, that it is a business with the capacity to go out and acquire other businesses, to look at opportunities and to, carry on its strategy through other names, going forward. I think one of the ways to look at the Coles divestment, though, or the divestment of the bulk of the Coles position, what I like about that is that it does highlight to the market as well that Wesfarmers management, excuse me, it's not afraid to go out and actually take its profits or take the money off the table when it feels the time is right. It held on to Coles, I think, for 14 years between 2004 and 2018, and then decided, no, it's now time that we put this back on the market. It did also redistribute some of the capital from that to shareholders in the form of a capital dividend, a special dividend, and it's actually in the process of doing that again. It's actually got an event this week, or a meeting this week, to determine whether it should distribute another $2 to per share to Wesfarmers shareholders as well. To be clear, that isn't proposed to be a dividend. That would actually be a capital return. So the way that would be treated differently is, instead of being treated as a dividend, it would be treated as a reduction in the capital cost per share. So there is a slight difference there in terms of the tax treatment. But I just think I guess in a way, this is a way that investors can gain a diversified exposure to Australian businesses.
It's a nice one, man. I'm glad you explained some of that, because what I really like about Wesfarmers, I'm not a shareholder, as I said, but what I like about Wesfarmers is that Coles deal. They could have, if you were trying, we talk about empire building, and we sort of use it pejoratively, and there's a reason for that, because a lot of businesses, a lot of CEOs do build their empire because it kind of is good for the ego rather than good for shareholders. Wesfarmers could have sold Coles in a trade sale to somebody else and taken all that cash and then built the war chest and then bought something else and built the empire. In fact, they chose to simply spin off the majority of that business to shareholders in effectively a distribution of those shares. And so Wesfarmers got very little money from that deal, at least from the bulk of that, because it said to the shareholders, rather than, hey, we'll sell it, we'll take the money, we'll invest it for you, they said, well, here's the Coles shares. Go and do with them what you want. They actually made the Wesfarmers business smaller as a result rather than larger. It's a sign that management aren't interested in building their own egos or their own, as you say, empire for its own sake. They don't want to be bigger just for the sake of being bigger. They were genuinely saying, well, look, we think shareholders are better off if we simply reduce our business by splitting it, rather than trying to sell it and get some money, we can then go and buy something else with it. And I just thought that was, for a business that could very well have justified a sale and said, well, we're getting the best price and we'll use that money for something else. They actually chose to do what I think is the egoless thing and actually spin that off in the right way to shareholders. So that's another quick editorial. Let's get back to you, mate, because this is about you, not about me. Let's talk about Wesfarmers, the investment now. So you've given us the summary of the business, what it does, how to think about it as an industrial conglomerate. Let's go to the pros, and then we'll go to the cons. If you're going to recommend an investment in Wesfarmers today, what bull case would you make, mate? What would you tell people as were good reasons to go and buy shares in Wesfarmers today?
Well, I guess I'll start off with the financials there, Scott, in terms of how they performed over the 2021 financial year. And for a company this, for a company this size, it's actually done really well over the past year. So revenue was up 10%, and that's certainly not off a small base, mind you. That's to nearly $34 billion in annual revenue. What was particularly pleasing, though, about this as well was that operating earnings, or EBIT, earnings before interest and tax, that actually rose 21%. Net profit after tax a little bit lower than that operating earnings market at 16%. But what I like about this is that the margins themselves are expanding, and that's a sign of scale. And I think part of that, I think can be attributed to the COVID world. There have been adaptations that have needed to be made over the past couple of years. But I think as well, the learning process. So I mentioned before that Wesfarmers acquired Catch Group or catch.com.au. That is now actually considered part of Wesfarmers Kmart segment. And what I like about that is that Catch is very e-commerce driven, whereas Kmart and Target, traditionally not so much. I think with the learnings and bring them under one umbrella, so to speak, I think that those brands can actually learn from Catch and can actually start to, I guess, put some of those advantages and those learnings to work across the broader group. So I really like that they did manage to improve margins, and I think there is capacity to continue doing that over the coming years. As well, the dividends per share, they announced total dividends of $1.78 per share compared to $1.70 in the previous year. Free cash flow was down actually quite significantly on the previous year, but I think there was a pretty good reason for that. So free cash flow, $2.7 billion for the year, compared to $5.2 billion the previous year. Reasons for that, there was a normalization in working capital over the year compared to the previous year in COVID, and also just to do with some of the divestments and acquisitions made by the group. So pretty good reasons there. So I think the financials are a pretty reasonable reason to go after this business and to think of it as a good idea. The diversification benefits as well that it provides to investors. I mentioned that before in terms of looking at the overall conglomerate. So the umbrella that is Wesfarmers brings a whole bunch of diversified operations under the one roof. And I like that as a conglomerate as well, Wesfarmers can really direct resources to where it believes it is best suited. If a brand isn't performing and it doesn't believe in the merits of it, it's not the entire business, and it can just, worst comes to worst, so it can actually choose to ignore that and to distribute the resources into a stronger part of the business, or a business that it believes has better growth potential in the future. And that provides flexibility to the group as well. It's making good moves. So I mentioned its move into e-commerce with catch.com.au, and I think that can help to boost the advantages across the group, across some of the other businesses in that business, as well as the lithium play as well. It bought a lithium play, Mount Holland, in recent years, so it's starting to go down different avenues to explore new growth opportunities as well. Strong competitive position. So as I mentioned, 5% position in Coles. Otherwise, though, Bunnings and Officeworks are leading businesses in their markets, and it has the firepower as well to make other acquisitions with strong cash generation too. It also pays a really good and reliable dividend yield. I mentioned before, it's one of Australia's favourite dividend plays, and for good reason. And growing margins. So those are some of the bull case reasons to invest in this stock.
Man, you made a very strong case, can I say? A couple of thoughts, actually, just quickly, as you mentioned. It is, and I guess it's tempting to draw a straight line. Wesfarmers may be deliberately doing this or not, depending on how they see the future, but they're divesting from coal and buying into lithium, which very much talks to the new energy, the old energy, new energy story, or, getting out of fossil fuels and into, of course, electric vehicles and others. So that's just kind of a fascinating byline. I don't know if you have any thoughts on that. But also, too, I have a very strong view that Bunnings is by far and away the best, highest quality retailer, bar none, in the country. If it was a standalone business, speaking of conglomerate discounts, I think it'd trade for a very pretty penny. It has return on equity that is just through the roof. Its sales growth is phenomenal. Its margins are outstanding. I really do think it's probably the best retailer, and it's going to be close to one of the very best businesses in the country, certainly outside the software sector. If you think about the economics of that business, it runs on the smell of an oily rag, makes $1 squillion for Wesfarmers. Just thoughts in general on the Bunnings business and the coal to lithium kind of move from Wesfarmers.
Yeah, look, in terms of Bunnings, I completely agree on that. I think it is one of the strongest retailers in the country. And I think probably going back to that Woolworths contrast, Woolworths obviously tried with the Masters brand a couple of years ago and failed miserably. And that was a real embarrassment, really, for the company as a whole. And I think it probably did highlight as well, though, the strength of the Bunnings position and Wesfarmers in Bunnings. It really is the go-to for tradesmen and women, but also just people who, want to get weekend projects done at home. And I think that's been highlighted as well through the COVID period. People are spending more time at home, and they do. It's one of the things that people have been dying to reopen. Bunnings, just get back down to Bunnings.
Yeah. Exactly, mate. I've got a chicken coop, which it was a 2020 Bunnings COVID project. So I've done my bit for the COVID, for the Bunnings bottom line, I should say. All right, mate. That's the bull case. Let's turn our attention now to the bear case, and I will get you at the end to summarize this for us and to make a call. But for now, let's just stick with the bear case. If I owned Bunnings shares and you said, Scott, you've really got to sell them, mate. Here's why you should sell or avoid Wesfarmers shares. Let me get that right. Wesfarmers shares. What would you tell me, Matt? What would the reasons be for me to sell my Wesfarmers shares today?
Look, right now, in terms of the price that investors are paying for the Wesfarmers shares, Wesfarmers shares have run up in price, and one of the reasons is the multiple expansion on those shares. And what I mean by that is, if we think of a stock in terms of, the stock might generate $2 in earnings per share. If the stock is trading at $40 compared to that $2, then it's trading on a 20 times multiple. No. If that earnings component doesn't adjust, but the share price goes up, then all of a sudden you're paying a higher multiple, and therefore the stock is more expensive. There has been multiple expansion with the Wesfarmers position, and I think part of that has probably been COVID driven. I mentioned before there has been a strong run up in margins. Also, the company has also mentioned that the start of FY22 has been weaker than FY21, and I think that's largely down to the fact that it is cycling compared to a very strong comparable period in last year. In terms of where the stock could go, though, I think investors today could be paying a higher price than what they historically have for sure, which is a reason to potentially sell out on that strength before that multiple contraction kicks in. So I think that's one valid bear case. I think the other thing as well, you mentioned this before in terms of the discount that conglomerates often attract. Now, conglomerates do have a lot of firepower. They have the capacity to bring in. It is its business model to actually bring in businesses that are unrelated under the one roof. But that can also attract a discount. Reasons being one of the major ones that management might not necessarily have experience or the expertise to run a lithium mine, for example, as it is right. with Mount Holland. It's gone from coals to Mount Holland. So that is one reason. Yeah. And you also mentioned the other reason too. It can make it more difficult to actually value. Splitting coals off on its own, potentially increase the value for shareholders because it's sort of splitting that out, and the value that is coals can more easily be recognized. So there is that that bear case too. I think also rising interest rates could potentially act as an anchor on the share price. So dividend stocks have been attractive, particularly in this low interest rate environment. If interest rates start to rise, then all of a sudden those dividend plays may not be quite so appealing to the investing public. So that's possibly also another reason going against it.
Nicely done, mate. I'm sorry I took you up earlier. I didn't mean to, but are you a believer in the conglomerate discount? I should ask. I made the editorial kind of statement before. I find the whole thing a little bit strange when a group of shareholders, investors, the market in general says, "Oh, we can't possibly value it when it's together, but if you separate it, we can value it for parts." Like it's 1 + 1 somehow equals 1.95, and it's like, guys, we know the ones. Like I don't know. It's never made any sense to me, mate. It feels like a cop out for investors to say, "Oh, we can't possibly value this as highly together as separately." Am I too jaundiced? Am I too cynical, or is there something to it? Do you reckon?
Look, I think there's something to it. I don't think the discount is huge. I don't think you're going to be paying 20 or 30% below what the Woolworths Group separately is worth. But I do think it exists, and I think I'll go back to the Coles example. If you split Coles off as a separate business, then Coles can strategically pick its own path. It doesn't need to go through the Wesfarmers parent company to do that. I think it has the capacity, if they were all separate, to go about their own strategies individually. To really drive that value growth. So I do think it's a thing. I don't think it's a major hindrance to the value that shareholders can recognize, though.
All right, mate. So you've given us a very convincing bull case. You've explained why I should go out tomorrow, Monday morning, and buy some Wesfarmers shares, and thank you for doing that. You've also given a very thorough, very convincing bear case. You've summarized why maybe I want to give it a miss. Maybe the price is too high. Maybe the business isn't quite the business that it was. And as you say, if rates go up, that might well depress the shares of businesses like this, particularly given that multiple expansion. So I'm on the fence. I'm going to make you get off the fence and lead me in one direction or the other. We are long-term investors here at the Motley Fool, so we don't know nor care what's going to happen to the share price over the next day or week or even year. We'd love to know, by the way, but we don't believe you can, so we don't bother trying. We're looking out, I'm going to say 2026, mate. Take me out 5 years from now. If I bought Wesfarmers today, do you reckon, and we don't know for sure, and as always, we recommend you, dear viewer, be diversified, but we are trying to pick individual companies and have a view on those. If we get those right more often than not, then we hope to be market beaters. So it's important to try and put some in the yes pile and some, maybe even many, many more in the no pile. We're trying to just pick the ones we think are market beating. So this is a long run up, Rhino, to put you on the spot and say, between now and this time in 2026, do you think Wesfarmers will be a market beater, or you expect it to lag the ASX between here and then?
Look, I think going back to the strength of the businesses under this umbrella, so to speak, I think that can really help to propel this company forward. So you've got the Officeworks, the Bunnings. There's really no, as far as I know, or as far as I'm aware, there really are no businesses that are even close to competing at the scale that those are. So I think they're in a really strong position to carry Wesfarmers forward. Wesfarmers is also one of the top 10 positions, though, in the weighting of the ASX 200. It's around 2.4% or thereabouts of the ASX 200. It's a very largely followed company, and that makes, I guess, lower and more predictable growth, which doesn't exactly work in Wesfarmers' favor in terms of beating the market. As I said as well, it's also trading at higher than historical multiples, which also plays against it. What I do like, though, is that it's gaining exposure to, I guess, more powerful tailwinds. So you've got the tailwinds of e-commerce, particularly through the catch.com.au acquisition, which I think it can start to roll out some of those learnings to some of its other businesses, and also to lithium, which I think has quite a strong long-term tailwind as well. Look, I think the fact that it is quite a big component of the ASX 200 does make it difficult to actually beat the market, certainly soundly. But I like where the company's going, and I think it has the capacity to beat the market, just potentially by a very small or narrow margin. That's in my opinion.
Very nice. There you go, Ryan. I wasn't sure which way you were going to go. You did a beautiful job there of keeping the edge of my seat. I thought you were going to go yes, then I thought you were going to go no, and you pulled it back out of the fire with a yes at the end. It's a really good point you make too, mate. We do need to wrap it up, but it's a good point you make that the more followed a business is and the less variable its future is likely to be, the better the chance, generally speaking, again, these are all generalities, but the better the chance that it's going to be reasonably well priced, right? If you know there's a small range of futures, everyone knows what those small ranges are. They can price it reasonably efficiently and effectively. There is simply just less room for uncertainty and therefore less room for outperformance, which is a really, really cool point. But maybe if you're a hyper growth small cap investor, Wesfarmers is not the business for you. But Ryan says, I think you might be right too. It's likely to be a slight outperformer over that 5-year time period. Rhino, thank you for spending your time with us. Thank you for sharing your expertise with us, with our viewers. I know they appreciate it. I certainly do, mate. I always enjoy chatting with you. I have some ideas for some follow-up videos, by the way. So stay tuned after this video. I might hit you up for those. But in the meantime, thank you for joining us. Thank you, dear viewer, for spending your time with us. So on behalf of Ryan, myself, and the whole Motley Fool team, until next time, thanks for watching and Fool on.